Live from 42nd Street in Midtown Manhattan, New York. I'm your host Harbin, and you're watching Monthly Financial Health Check for the month of April 2023. Let's check our first segment at You Only Live Once New York Market Summary. We have seen in the month of March the Nasdaq actually rose quite a bit from the lows of February. It ended up at 12,221, while S&P actually rose to 4,109, and the Dow Jones Industrial Average settled at 33,274. Historically, March has been good for stock market. And as I have basically indicated in the March newsletter, health check, that the market will basically be doing well in the month of March, and I anticipated that, and because of that, I actually diversified my single stock concentration in the month of March. And I built up two stock portfolio in 2022 over a 6-month period, and then I liquidated that much amount from my single stock concentration in the month of March. So that way, basically, the stock market actually did what it was supposed to do, but there was quite a lot of hiccups. The treasury market basically went the other way after the Silicon Valley Bank collapse. The 10-year treasury yield is settled at 3.473% from the high of 3.88% in February and January. So that was actually basically a big blow to the fixed income assets. As I told that, okay, I was able to liquidate my single stock concentration position, and I actually moved half of that money into medium term strips, so that I can actually take advantage of the 4% interest rate. So those are actually now doing well because the interest rate has gone down to 3.473 now. The gold is basically did well. It is now back above the last year 2022 levels. So if you look at March of 2022, it was 1942, while in April of 2022 it was 1911. Now it is basically above 1979. So the gold has basically have been bullish. But I think it's basically due to the turmoil in the financial market because of the Silicon Valley Bank collapse. People actually flooded to bullion, and that's why the gold has done well in the month of March. Compared to the last year performance, the market was actually going down from March. It was basically all three indices were lower in April from the March, and the trend is now on the other side, that okay, going basically the stock market has been going up since January. The inflation seems under control, but the Fed resorted to 25 basis point only instead of 50, which was anticipated, but that happened only because of the Silicon Valley Bank collapse. The US dollar lost some of its glamour and eased against the major currencies March 2023 to 0.9219 against Euro, 0.8109 against GBP, British Pound, and 82.13 against Indian Rupee. So what we are basically anticipating is that March was a stable for stock market. Stock market actually has done well, but it's because of the rising consumer confidence, and the inflation is basically under control to some extent. Unless the inflation actually comes back, the Fed might actually slow down on the rate increases. If the Fed started to ease, the stock market will pick up more. So what did we learn from the market in March 2023? Our take from the financial crisis that hit the Silicon Valley Bank and the other is to learn from that. And the point we learned that it's better to diversify. There's no point in taking any stress about your deposit. It's your hard-earned money. You worked hard for 30-40 years, and if you basically lose your deposit because of your banker's inability to basically do the right thing, then it will be a very sad situation, and there's no point taking such stress, and nothing is too big to fail. So it's better for you to actually have diversified investment and in multiple brokerage house, multiple banks, instead of basically thinking that whether it's JP Morgan Chase, whether it's Bank of America, whether it's Citibank or Wells Fargo, are too big to fail. So we took that lesson from there, and the first thing we did or started doing in March is basically opening new accounts. So I opened an account with JP Morgan Chase, brokerage account with JP Morgan Chase. I already had a checking account with them, which I was not using. It was dormant, so I actually got it activated. I need to go to the branch to do that, but then I opened an investment account there, and they were actually, I have a video for that. I upload how to basically negotiate to get bonuses in order to basically create. So that's actually a good thing. You can do that. Same thing I did with Wells Fargo. I opened a new checking account and then a new Wells Trade account, the investment account. And I also got bonus over there. I'll create a video for that also. So it's actually good to shop around and basically diversify. So I have a video on SIPC coverage, and according to that, you can check it out. Your accounts up to 500,000 are protected, and your accounts in 3 different categories are protected. So your after tax, your pre-tax, and your tax-free. All 3 accounts are separately protected up to 500,000. So now by creating multiple accounts, so I have now 5 banking accounts with 5 banks. That is JP Morgan Chase, Bank of America, Goldman Sachs, Wells Fargo, and Citibank. I closed down my Sophie and Community Bank, which was Bread Saving and Lending Tree. Those 3 because there was some or other restrictions with, you can check out my video on the high yield saving accounts, and I have explained what are the restriction with those, and I didn't want to basically. So the point here is that you don't need to take this. There are so much options nowadays, and there are so many offers. So you should basically have accounts in banks where there is no restriction. You can easily transfer all your balance in a day. The 5 brokerage accounts I have now created is with Merrill Edge, which is Bank of America. That was our primary after-tax brokerage account, and now basically I have all 3 types of account with them, basically after-tax, pre-tax, as well as tax-free. Similarly, I opened now a JP Morgan Chase account and a Wells Trade account. Both Chase account and the Wells Trade presently will be after tax, but I will try to basically diversify pre-tax accounts into that too. Then Charles Schwab, I have both pre-tax as well as the after-tax, but majority of that or the sole thing is actually the company stock in Charles Schwab. So because the company actually does bank with that, so all the company stocks are with that Charles Schwab. So there is less control over like how much I can have in that after-tax account, but I'm still trying to basically see how to actually diversify that too. Then I have account with Fidelity, but that is mainly my 401k account through company, and that's also I don't have much control, but I'm still thinking how to basically diversify that and have basically move the money around to Chase and Wells Trade for creating a pre-tax account there. So the point is that don't just sit around. Make sure don't fall to any of in any situation where you have more than the covered amount in any of the bank or any of the brokerage amount. So the first thing you need to do is basically learn from the Silicon Valley Bank collapse and do a health check of your account, and that's what our attempt here is. Every month on the first Saturday of each month, we want to basically take a look at our accounts, do a financial health check. And please, if you are a viewer of this channel, a viewer of my videos, do this with me. When I'm basically doing this, you also do this with me and do a financial health check of your financial situation, and then look at the market, look at your situation, anticipate what's going on, what to learn from the financial situation in this month, looking forward to the next month, and see where you are, and then it will give you a peace of mind that you have full control over your finances and you will be in much better situation. The big part of financial health check every month is to look at your portfolios to see where they are heading and if there is any scope for basically making changes depending on the market condition. So the first thing is to check dividend stocks and the growth stocks. As you have seen previously, that we have created two portfolios last year. One with dividend stock, one with growth stock, both with the same initial capital. Over a 6-month period, we try to basically look for bargain and anticipating that we will be selling our single stock concentration in March, and the amount of money basically we will be diversifying. We went ahead and started creating these two portfolio with that much money in mind. The point was doing that in last 2022 6-month period between April and November is to take the advantage of the stock market going down, and then basically when it recovers at a healthy level in March, which it actually ended up being, it was a good balance between buying things at low and then selling it at a high. So let's first look at our dividend stock portfolio. We started with almost $220,000 this portfolio, and its present value is $255,237. With a gain of 33,297.29, which is a 15% of the portfolio value. So the portfolio has returned us 15%, and if you look at all the stocks in the portfolios are actually on the positive side, except one, which is Pfizer. And let's look at the amount of investment income it is going to generate us over the year, it will be $4,709. So if we add that to the portfolio value, so it will be around 260,000 instead of 250,000, but it's not much. Let's compare that with our growth stocks. So if we look at the growth stocks, the growth stock is also, we basically started with the initial capital of 220,000 and it has returned 93,985 in profit till now, which made it a total value, a current value of 316,195, which is a 43% return. So if we compare the growth stock with the dividend stocks, the portfolio of the growth stock has given us 43% return in the same time frame with respect to 15% in the dividend stock portfolio. Now, does that mean we should only invest in the growth stocks and not invest in dividend stocks? But we cannot say that now, because we have to go through the whole cycle. Had we started this portfolio in prior to 2020, we would have gone to the dip in the stock market in 2021 December till 2022 December. Then in that case, we would have basically seen how our portfolio do with respect to the bear market. Okay, we can't say that now we are in a bull market, but basically we started building these portfolio when we were actually in the bear market. So when the stock market was going down, we were basically picking for good options and then building this portfolio. So until we go through another cycle of bear market where the stock market actually dipped, because we anticipated that the dividend stocks are slow maturing, and so if they go up slow, they will go down slow too. And the growth stocks, if they go up faster, they actually do go down faster too. So we have to see the falling stock market and then see how our growth stock does in the falling market, and then take that decision. So that's why we will be monitoring these portfolio every month as part of our health check. So we want to basically see, do we have to basically do anything to any of the stocks, the portfolio, the stocks we have in the portfolio. At this point, we don't anticipate major changes in any of these stock, and we are still confident that these stocks will do better going forward than worse going forward. So that's the thing. That's what we want to basically take every month a look at, to looking at the market condition and our portfolio to basically assess whether these stocks will do worse in the coming months or will do better in the coming months. So our bet is that if the inflation doesn't drastically pick up, the stock market will actually be steadily rising over the 2023. The only headwinds basically are the inflation and the political headwinds. Those are the two things we basically warn you about. So the next thing we want to basically look at our fixed income assets. So as part of our fixed income assets, if we look at here, we basically push a lot of new US Treasury strip in March, which is a total of 600,000 matured value. The current value of this portfolio now is 883,611. It's basically 1.35%. It's basically 1.3% with respect to the current bond market, basically, because the interest rate has gone down So after we basically purchased these strips, the interest rate has gone down, and we basically are seeing the benefits of that. So if you have seen my video before that, okay, I've actually recommended buying strips in the pre-tax account and buying bonds in your after-tax account, because even though the strip does not give you any interest, okay, the tax are due every year. But I ended up buying strips here in my after-tax account because I wanted to maximize the impact of my dollars, because I know that the treasury rates are easing, okay, and I wanted to basically make sure that I took the advantage of 4% rate at this point, and be able to stash these for medium term, and I wanted to buy the most my money can buy. That's why I went for strip, because for the same amount I actually buy more treasury strips than treasury. So if you look at the mature value of these strips at 300,000, while if you look at the amount I have basically put is around 200,000. So that was the thing. If I actually buying bonds for this, I would have bought bond only for 200,000. But for strips, I actually can buy matured value of 300,000 for 200,000. Even though if I actually bought the bond at the same interest rate, if that interest rate was paid to me and I actually accumulated that interest into these bonds, then my overall matured value of the bond would have remained same to 300,000. But the point is that, like, if you are getting the interest in your interest saving accounts or something, it's very difficult to be basically in that situation, putting that and then back into this and then actually. So you can do that. You can actually put the interest back into the same account and then actually buy bonds going forward, but then you will be not necessarily buying the bond at the same 4%, because it will be less and less if the treasury rates are easing. But in this case, you have logged in that 4% for that much period, and by basically buying the strips. So look at the interest it is going to generate over the next year, which is around $15,000 for these treasury bonds. That's the difference. If you want to know more, leave me a comment and I'll actually be able to create a video out of it. But as you know that, okay, we have moved some of our money into the Chase, because I opened the JP Morgan Chase account, investment account, brokerage account, and then moved some of the treasury bonds from the Merrill Edge account into the JP Morgan account. So the JP Morgan, basically we have moved to two of our treasury bonds, the treasury notes, one 102 maturing at 102,000 and maturing at 178,000. So total of 278,000 with the current value of 275 to 273, 422, 81. So that basically, along with the 883, it's almost basically is $1.2 million in this fixed after-tax treasury we are basically building. So that's where we are with regards to fixed income assets. The other thing we want to basically look into the rental income, as you can check my video that we started rented our second condo from April 1st, which has started giving us rental income. And since I'm still working, we would like to basically not pay taxes on this rental income, so we'll have to actually find ways to basically take a depreciation on the condo. So I'll actually create a video on that, how we will actually do it once we do it next year. The point here is that, okay, if we basically don't do that, we will have to pay almost 60% of whatever basically this will generate as taxes, because that will get added on top of the income I already have. So the best thing is to basically take depreciation now and not have an income, and then once we basically have to sell in future the condo, then we can actually have the cost basis low and the gains will be more, but those gains will be capital gains and they will be basically taxed at 20%, so or 50% depending on what's the income we have. And in retirement there is no point taking the depreciation unless you are going to pay more than 20% in taxes, but you can actually see how much taxes you are going to pay, and you can then actually take that decision. But the point here is that multiple income stream is the best thing to actually have in retirement, because the only thing which is worrisome in retirement is loss of value of your money. So if you put everything in stock market, okay, so that will be inflation protected, but then if the stock market goes south, then your portfolio value goes south and you won't be able to withdraw the same amount of money for your upkeep. So that's actually not a very sound argument in actually putting all your money in stocks. So then if you put all your money in fixed asset, even though at this point or last 6 months you could have gotten 4% for your 30-year, okay, so if you put up all your portfolio money in that and you said that, okay, you will be getting 4% for rest of the time in retirement, but if the inflation stays high, the value of that money will go down, and then slowly and steadily your quality of life has to basically go down unless you have to withdraw more and more from that portfolio, more than 4%. So in both situations that, okay, you will actually have issues. So even if you split them in bond and this thing, then you have some sense of relief because you will have the inflation protected stocks and then steady income from a fixed asset. But if you diversify more by adding rental income or diversify more by having more investment properties, the real estate in many situations basically holds values much better than cash or fixed income assets. The example of that is that, okay, if the inflation is high and the value of currency goes down, your fixed assets basically lose values. But the real estate tends to hold with upkeep with inflation. And so we would like to add another international investment property over the next 2 years. If we come across a good deal, we'll keep you posted if we ended up doing that. The market we are looking into is Europe as our top choice, followed by South or East Asia. So we haven't made that decision yet. We will actually look out for a good deal. If we get it, that will be something we like to add to our portfolio before retirement. Finally, what is in store for April 2023 and how we should prepare for it. In our view, inflation is still not done, and it is one of the biggest hurdle towards the recovery of the stock market. If the inflation is still coming strong, Fed will be forced to basically keep up the increase in the interest rate. Another 25 basis point is given, but in case inflation basically is going to surge, then it can actually result in a 50 basis point increase from the Fed, and that will be a disaster for stock market, in the sense that it will give the stock market a breather again, and that might be actually a good time to accumulate more stocks in that case. We do have some basically capital in our tax-free account for that particular purpose. So we are keeping that around in case there is another dip like last year. Then we will try to take advantage of it and then accumulate some stocks. The same things we have with our pre-tax. We have some capital around to basically, if the treasury bond again give us 4%, whenever we get a 4% deal between 15 to 25 years, we will basically stash in our pre-tax, because our withdrawal criteria from our pre-tax is not going to be before the 72 or 73, when we have to actually take the minimum required distribution, and that is still like 13-14 years ahead. So I think we have given a good overview of the market in the March, and a sense of how the market will behave maybe in April, and how to prepare for the market in April, and to do a health check of our portfolio. I hope you did the same thing along with me, checking your portfolio for any weaknesses, anything which would like to make change at this point, and how to basically proceed with how the market is behaving, has behaved in March and likely to behave in April. If you like this video, you like this topic, please subscribe to my channel and like the video, leave a comment, because that will helpful in deciding what type of videos I would like to actually do for retirement planning. But tune every month on the first Saturday at 10 p.m. Eastern Standard Time and 7 p.m. Pacific Standard Time for a financial health checkup with Harbin. Once again, I hope you enjoyed this financial health checkup, monthly financial health checkup, and you have a great day.